I want to talk about Cove Markets. And Cove Markets is an interesting startup. I think, certain startups you kind of know that, it's a great idea right from the start. And I think it really helps when there's kind of like a sense of mathematical certainty that the particular idea in question is useful or that can bring something about to markets. And that was what was there for Cove Markets, because in economics, there's this theory that markets tend to efficiency, and I think this is pretty easy to sort of believe by inspection, because people don't want to pay more than they have to for anything, right? And even so, when there's non-market factors, the markets eventually correct out those non-market factors and go to efficiency, because just nobody's going to pay higher than they must. And now, of course, it's really important to remember Warren Buffett, and like paraphrasing that, markets don't necessarily go to efficiency on the same time as the solvency of your portfolio, right? So just because you think the market is wrong and you bet against it doesn't mean you're going to make lots of money. But anyway, in the Cove Market setting, we were interested in this problem because for cryptocurrency trading of basically coins, you have all these centralized exchanges, really hundreds or more, maybe even like as many as like 300 different centralized exchanges, and you have liquidity fragmentation. So there's no way, really, if you think about it, that can't possibly be an efficient market, right? And so we have to think about, solutions to this problem. And it's interesting to me because, in cryptocurrency settings, people almost always talk about like arbitrageurs, like, arbitrageurs are the solution to this, they'll solve everything. And so there's also a question of like, why don't arbitrageurs solve this problem? And, it's interesting because we have to talk about like what an arbitrageur typically is. And so most arbitrageurs are professional traders. And most professional traders work at large trading firms. Large trading firms have like, dozens probably of just like engineering employees dedicated to supporting their desks. And each desk probably, has a minimum of say like 1 or 2 engineers dedicated just to that specific desk. And that's not even to mention the infrastructure costs. A large trading firm like a DRW or a Getco, where I've worked, they would literally have billions, like with a B, invested in their infrastructure to be able to outperform and build the best trading system that you can possibly build versus their competitors. So when an arbitrager is looking at this problem, it's not necessarily going to be an attractive place for them, because think about, like, say that you have Bitfinex trading, late at night at 2 a.m, and maybe there's just like one order on the book. And so a market maker, you might make the argument that they're going to say, oh, well, you can charge a 20% premium and you'll come in and you'll make good money. But if you look at it from the perspective of a professional trader and they're saying, oh, well, 20% on one trade, it doesn't justify my existence, because remember, we have millions, if not more, invested in this. So they really have to have like a strong order flow to be willing to participate at that, trading level. And of course, there's mom and pop traders and trades of gray and individuals and stuff that helps a little bit. But at Cove Markets, what we did was we would make a note of some of these, like sort of out of line with best bid and offer trades, and we would see them all the time. It would be a frequent occurrence that you would see, Bitcoin trading $100 off of, what the best price you could get worldwide is. And so what's the solution? The solution is something called NBBO, and NBBO is like a trade term. Basically, it's a regulation in the United States. And so all equities and securities that trade in the United States have to provide to US-based traders what's called best bid and offer. And best bid and offer means that you get the best price, whether you're a buyer or a seller, nationally. So an example would be like, let's say, IBM is trading on the New York Stock Exchange, and it might also trade on the American exchange. So if it's listed on New York Stock Exchange for $10 and it's listed at a great price of $8 on the American exchange, then it's actually the responsibility of the New York Stock Exchange to go through a back channel, connect to the American exchange, get that lower price trade, and pass that on to their buyer if they're buying. So the buyer in the United States is guaranteed an efficient capital market. They're guaranteed the best price. And the way this has actually happened, because exchanges are big and complicated, rather than doing those back channel trades, what they often do is they just set up an exchange agreement and say, okay, we're both subject to the same regulation. We'll both follow each other's order books. And rather than making the trade on my exchange, just go ahead and mark it in your logs. And at the end of the day, we'll compare our logs of everything that was traded and just settle up the differences. So those exchange agreements are very important to this question. So from the standpoint of being a startup, it's also really interesting because if you think about it, like, what's the job of Coinbase? Well, Coinbase is investing, a lot of money to build an infrastructure to support all of its trading volume. But if you think about what Cove Markets wants to do, is they want to consolidate the order book so that you have best bid and offer worldwide for all cryptocurrencies for all the exchanges. So it's almost like supporting the resources of hundreds of exchanges. And so that's one of the challenges. So what I want to talk about is how we solve that. And in order to do that, I'm going to talk about basically how traditional financial markets worked. And this is sort of, the architecture that we wanted to build right from the start. This company called Island, which was acquired by Instinet, basically they consider themselves to be like the pioneer of electronic trading. They were ultimately acquired by the NASDAQ, and now this architecture is kind of universal in electronic trading. Every trading firm, every investment bank, every exchange that you go to will have some flavor of this architecture, and it's usually their bread and butter. They've invested millions of dollars in developing it, and it's like they consider it intellectual property that helps them power their exchange for what they want to do. And it's actually kind of also interesting from a financial engineering perspective. I went online, I couldn't find an exact picture, but the picture I'm showing you is basically a picture of like a standard trade ticket. So if you look back like in the 1950s or 60s, not the very early days when like trade ticket was like a slip of paper, but once trading had gotten organized, this is what people would have is kind of like this what's considered like a consolidated trade ticket. And they would literally on, like pencil and paper write in, how much, what security, what price they wanted to pay, and they would accumulate all these trade tickets, and that was a stock exchange, right? That's how you run it. And it's funny because like with a beginning trader, right, you might actually do this where you sit down and take, start with 100 shares and have somebody write down, what they're willing to pay, and have somebody else have, what they're willing to sell it for, and kind of you could run the market on paper, let's say. And it's almost coming at it from the perspective now where we have issues like, ES futures on the CME that trade at like 250,000 orders a second. It's almost incredible to think that a long time ago that it was written down on paper like this, that, people were making trades like this. And it's also interesting to see because like once you've seen enough of these architectures and, the data structures that they use, you can kind of see that, there's a familiarity between all of these form fields that are in there and the events that are getting passed around in these island architectures. And in fact, some of the early, more primitive versions of this used what was, kind of colloquially referred to as ASCII. And what ASCII was is basically just all these fields. You'd have quantity with the quantity. It was literally a text string that was published around. And so how are they publishing around? So what's this protocol? The protocol is very simple. Basically what you're going to do is every event that comes in, you're going to apply a sequence number to it. And the point of that is the sequence number is going to enable you downstream to guarantee ordering and reliability. And so we'll get that a little bit more in a second. But it's interesting because like basically, that's all you need. So let's talk a little bit about what you're sending around. So orders, it actually is a state machine, and probably, people who are like, not necessarily experienced financial engineers might not realize this. And kind of the way that, cryptocurrency works, it doesn't really have this kind of state machine. It's like sort of the transfer is a transaction, so it's a little bit more, it's a little bit kind of like less of a state machine. But like in a market order management system, you would really have this kind of state machine. And a lot of people that have interacted with this may be kind of familiar with the feeling you get from the state machine. Because like if you go onto your broker and you make a trade, most people are sort of experienced with the feeling of like, the trade sort of goes out there after you submit on your browser, and you kind of wait a second, and everybody kind of wonders what's happening in that second. So what's happened is the order is open and it's going to the order gateway. And at that moment, the gateway really has a responsibility for validating the order or accepting the order. And the way that it validates is based on, a bunch of like simple principles. Like, does the person have enough money in their account? Is the form valid? Does it have, minus signs where it should be plus signs, or an impossible type of trade or something like that? So it basically validates it. And then so if it's wrong, it could reject it. Now I've placed a dotted line here to reflect that a rejected order might not actually go into the order store. And you could think about this from a data cleanliness perspective. Let's say the order was rejected because it's illegal, right? You don't necessarily want that in your store, even if you tagged it as rejected. Really, you want that kind of like something that you just don't want on your exchange out of the store. Now, there's another way. These pretty much at every level of the trading system, like at the sequencer level, things could be rejected as well for different reasons. Maybe it's even a software bug or something like that. So those kinds of rejects would go onto the order store, but you want to basically keep the data as clean as possible and reject as early as possible. If it's accepted, usually that order gets some kind of an order ID and it becomes a real order. Then once it's accepted, you still have the opportunity to cancel your trade, if it hasn't been filled yet, or there's fills that can happen. And so the fills, what those are, it's usually a separate stream. It's much more like the transactions that we're familiar with, like from blockchain, where the fills come through. So let's say it's 100 shares of IBM. One fill will come in, okay, I'm willing to take, 25, and the next one I'm willing to take 25. And this sort of keeps happening until it fills up completely. And so then you consider the order executed. Now I made executed a little bit gray. You may not be able to see that through the video, but the idea is that executed actually isn't a state transition, that oftentimes it's just published to be nice. So because there's these two streams, you could actually just listen to the fills and decide, okay, they had quantity 100, now there's 100 worth of fills out there, so we know the order is closed out. But a lot of times, just to be nice, the order management system will publish out like an executed event just to let software know. Maybe the software doesn't care about the fills for whatever reason, it just is keeping track of active orders. So it's nice to have this executed state, but it's kind of like a declaration versus a real state transition. So we can think about what the outs are on this. So the outs are obviously fully executed, canceled, and rejected. The other thing, in a real market orders management system, there's a lot more states than this. And I can think of like UBS Investment Bank, they had, I think, maybe like 23 different states in their order state machine. And they might even have order states that was for a particular customer. They have a lot of market makers that their customer, and they want to have, pending, cancel, rejected state sent to them, right? For whatever reason, if it's a big customer, they would probably just do it if they asked for it. So they had 23 different states, but this is like the basic model. There's also, reject, cancel, right? Everything could be subject to a reject. So you can imagine this tree expanding, but I'm trying to give you like the simplest version so we kind of understand. But what I want you to take away from this is, given the concept of outs, you really have kind of dead and live orders. And, we should think about even like kind of like how blockchains work in this scenario, because you could think of having, if you're operating an exchange, obviously the exchange has, tons of dead orders, right? Like all the orders are dead essentially because they've all been filled or canceled or closed out. And they probably only have a small amount of live orders, right? Maybe just thousands, right? So it could be, orders and orders of magnitude different. So it's usually these dead orders go out to some kind of a database storage. They're stored on the file system. And these live orders are kept in memory. And so, it should remind you a little bit of like how a blockchain works. Kind of continuing on and delving a little deeper into this, I want to kind of talk about event sourcing. And event sourcing is kind of a general architectural term. People use it in different ways, so I want to define it the way that I'm using it. So in the system that I talked about, I never said anything about deleted. Now, I did say that data can be filtered, right? So if it was rejected at the order gateway, right, that order never comes into the data bus. So that's different. But once it's canceled or fully executed or any of the out states, we don't have to delete the order. So what we can very efficiently do is build a read-only event store. And what's really nice about this is whoever's listening to this data stream, once you see that the order's open, you see that it's accepted, you kind of like know everything that's going on with the order. As long as you have a reasonable control over like the latency of your whole system, you can have generalized, concurrency across all these different platforms where they know the state that that order is currently in with the amount that's filled. It's also really nice because since a lot of these exchanges, their clients are market makers, they're key clients that they care about the most. And these market makers, they really want a low latency trade option available to them, right? Because one of the ways that they make money is by, being concurrent with the market, essentially, being able to be the first in line. And, everybody knows about like the famous speed traders, Getco and whatnot. And, it's a very terrible trade usually because like it's an exponential fall off, like the first person in line can be profitable, but every other person in line probably will lose money to the first person in line. So it's really tough, but a lot of these speed traders, they get paid by the exchange a market premium. So the exchange, essentially gives them a percent, like, hey, do business with us and we'll pay you for your trouble, because the exchanges really like to have that liquidity available for their other clients. And so it's kind of win-win. So these traders do it for that reason, even though sometimes the trade might be a loser. And so they want low latency. And so when we have a guarantee of thread safety, that's really good. And in fact, these systems oftentimes are single threaded. So for any given part of the system, only one single thread for latency reasons would be interacting with that data store. And so this can help like reduce latency at the scale they're trying to operating at. This event sourcing is great for like event-driven software. So nowadays we have modern network hardware that can actually notify the operating system when there's data available. So using the ePOL system call, we can build a network reactor that listens to these hardware events that come from the network card. It's basically offloaded from the operating system and wakes up and says, oh, there's data available. Go ahead and do your thing and handle that event. I already mentioned, deleting is a problem, right? Like if you have this stack of events that I've drawn here, how are we going to take one event out of that? So it's really nice if you have an order state machine that doesn't involve any kind of deleting. If it's append only, we can just get rid of deleting and not worry about it. Usually in databases, deleting causes all kinds of problems. It's also interesting because event sourcing has a kind of sympathy. Sometimes people refer to this idea of sympathy, where it has a natural fit for like human processes. You can think of somebody places an order and then somewhere out, in some other trading terminal anywhere in the world, somebody's going to see that order and then they're going to respond to it. They're going either place another order, they're going to trade with it, they're going to trade against it. So these processes are all event driven. And you might think, oh, well, there's algo trading and that's not a human process. But actually, in many cases, algo trading is driven by humans. There's a human, running certain algorithms and watching the algorithm behave and responding to the market. So it's still, a very human process with event response to events that are happening on demand. It may be more efficient versus continuously polling. And, that's kind of a question of whether you care about low latency or whether you care about, using more CPU time. So in a big exchange, they really care about how much CPU time they're spending, right? Because they probably have a huge data center that they're paying a lot of money for. And they don't just want to poll and spin lock their CPUs because they can give up a few nanoseconds for that. On the other hand, in a high performance trading, like a proprietary trading environment where they have CPUs dipped in liquid coolant to overclock them as much as they could possibly, and they care about nanoseconds, they would probably want to do continuous polling because in that case, they want the processor to be immediately available when that event happens. And they don't want to wait, maybe 100 microseconds for the processor to wake up and handle whatever the event is. So it kind of depends on the use case, but oftentimes it's considered to be more efficient. So how is this usually built, you ask? So as I've mentioned, it's purpose-built. I've described systems that are highly customized. They consider this to be the intellectual property of the exchange or of the proprietary trading firm. And it requires a very disciplined approach to implement this. So, in a nutshell, it's not great for startups. You have these individual threads for these data feeds that come in. It's going to go through a single event sequencer monolith that's usually highly tuned and performance purpose built to be able to do this job. And then it sends out datagrams out to all the client listeners. And so it's really interesting also to kind of consider datagrams versus TCP. Why would they choose datagrams? Well, TCP has a couple of things. For one, it has a larger packet size. For two, it implements heartbeating. And for three, it has sort of like a handshaking protocol that it does to guarantee the delivery of packets. TCP is designed to be robust. But it's actually interesting for most trading firms, and this may kind of be a surprising fact to hear, but failure actually is sometimes acceptable to a trading firm. And so what does that mean? Usually, it's fail-safe to not be in the market. So we have this sequenced event stream, and it's coming through 1, 2, 3, 4, 5. Everything's fine. But then if it gaps to 7, then every client would know, okay, we're now waiting on a packet. So it would give it a brief amount of time. It would buffer that event. If 6 comes in, that's fine. It publishes 6 and 7. But if whatever the time that's being considered for the timeout of the protocol to work happens, then it would basically gap and go into an offline state. So this allows the trading system to essentially be fail-safe. It shuts itself down when there's ever an error. And in that way, you can kind of get rid of all these overheads of TCP, and it's optimistic because you're assuming that the multicast is reliable. And I've already mentioned, that these firms are spending billions of dollars on their infrastructure. So they do have reliable networks. So it's actually very rare, in one of these top-end firms or exchanges to have a gap. They've got it sorted out so that they don't have to deal with those TCP overheads, but they can kind of publish it and just check after the fact for a failure. So what did we do at Cove Markets? Well, the challenge at Cove Markets is that it was a startup. So we can't build this purpose-built data broker. I mean, that would have been years of development time just in and of itself. So we ended up using Kafka, and the idea was that we would build a rapid prototype. So we wanted to have essentially the same challenge or the same bus structure for all of our data that we're publishing through. We still have individual data feeds for each of the exchanges, and then we're going to publish those into Kafka message brokers that operates as a cluster. And so one thing I didn't really mention, well, I kind of touched on the fact that these environments are often single-threaded, so each data feed might be single-threaded. But really, like at Cove Markets, and when you're talking about like crypto trading, latency is not at that same level. So there's no real crypto trading that occurs at nanoseconds or even microseconds. The best exchanges out there are operating in like a millisecond regime. So this idea that everything that would, be required to be single-threaded really isn't necessary. As long as you can kind of operate in the same millisecond regime that the exchanges operate in, you should be able to, stay concurrent with the market and everything's hunky-dory. And always the thought was, well, we can get it mocked up with Kafka, and then, down the road, as we become more legit and more substantial, we would, replace this with our own internal message bus solution or some other. There were some interesting challenges that we faced. So the point is to build a consolidated order book. And so each one of these data feeds would be an individual exchange, right? So you'd have Coinbase and, Gemini and Bitfinex, all the exchanges coming in, and then we would have inside our system a consolidated order book for all the exchanges, the worldwide best bid and offer for all cryptocurrencies. Then we had basically, a trading order router, what's called a smart order router in the language of trading systems, that saw that full book. When the order comes in, it matches it with the best priced order, and then can forward to the exchange. And so this is one of the challenges, and I'm going to mention it here on this slide. I can jump to it kind of right now. You have to think about it from a conventional trading firm perspective, right? So like for a proprietary trading firm, they would be concerned about nanoseconds. So it might be, literally, 5-6 orders of magnitude different than like what Coinbase is. Dealing with, like, say, an investment bank, their latencies might be, they might be concerned about something like microseconds, right? So even that's like a factor of 1,000, over what like a proprietary trading firm is concerned about. So there's this kind of fall off, and my point was that as long as you can kind of stay in that like millisecond regime, this is, the threading, right? The cost to latency is probably only like a 10% cost. It's not going to take you from, I don't know, we would have to kind of come up with some specific examples, but it's not going to take you from, 100 microseconds to 1 second, right? It's going to take you from, 100 microseconds to 200 microseconds, right? So you're still on the same order. And what I'm saying is that's going to be far below the scale of the millisecond regime where these centralized exchanges operate. So we can add threads within the cost of what we're expecting the required latency SLA to be. All right, so getting back to my topic, I wanted to talk about Bitcoin. So how does Kafka work? So basically what happens is Kafka takes the string hash of the topic, it takes a modulo of that for the number of message brokers, and that's how it determines which message broker you should be talking to. Now the challenge is that for, say, Bitcoin, the volume would be typically, 2 orders of magnitude at least. It might even be higher than that, than the next one down. And, a lot of times the next one down would just be, whatever was a current hot topic that day. So you kind of have this like 100-pound gorilla in the room, Bitcoin, and then you kind of have everything else. So it's a bit of a challenge from scaling a system, because everything is hotspotted into one event stream, and everything else is sort of like lightweight. You could probably handle everything else on just one additional broker. And the problem that would sometimes happen is instead of getting a nice uniform distribution like this, you would have something like this. So because the way that failover works in Kafka, what it would do is it would take the string hash. If that node that it was meant to be, it would take the modulo of the number of nodes to find which node it should be on. If that node is, currently down for whatever reason, the container crashed or something like that, it adds 1 to it and it flips it on to the next node. And so what you can have happen is Bitcoin, which is essentially going into this, this broker would usually be kind of like maxed out because Bitcoin volume would be so high. You have something else coming onto that node, and this can actually crash the node. And if that crashes the node, both of those things will then flip onto the next node, crashing that node, having like a cascading failure. And there's also another reason why this setup can occur. This setup could also occur because, let's say the hash codes, the last byte of the hash codes was the same, and you only have 3 chances, in this case what I've diagrammed for 3 different brokers, there's a good chance that you're going to have not uniform distribution, but alignment for certain, it's 1 out of 3. Something can come on to that broker by chance, and so your system will even fail to start up. So the way that we solved this problem is we had to basically pre-bake, if you will, what coins were going to go on to what broker based on the number, so that we knew that they were all going to spread out onto a different broker. And then we also had to look at, in a failure case, that there was some empty brokers, so that when it flipped, it would go to an empty broker versus going on to Bitcoin. But this is actually one of the challenges that we face with Kafka, because Kafka is essentially, this very plug and play nature. It's not meant to be like fine-tuned. And so we kind of got into a situation where we were discussing, should we rewrite certain parts of Kafka? And, it was actually kind of challenging because, we're in business to create a retail trading platform for cryptocurrency. We're not in business to make Kafka run better. So it was kind of like a long-term debate of okay, do we replace Kafka? I was sort of in the camp of, I didn't want to give up. Kafka gives you nice guarantees of reliability and distribution, right? By replacing it with like a simplified solution of our own like internal working and design, it may not give you all those nice features of failover and reliability that Kafka gives you. And I think also it kind of tends into that, well, if we really want to go that route of building a purpose-built event sequencer, then we could probably do better than starting with Kafka and like swapping out pieces parts and making kind of like a Frankenstein distributed system out of Kafka. So it was really, one of the challenges was, like tuning the system given the extreme hotspots and using Kafka. And Kafka doesn't really give you a lot of dials you can turn. You kind of have to accept the way that it works. Otherwise, you get down into the deep programming of it. And then the kind of one last key challenge that I will highlight is that working in a distributed system can be challenging. We ended up using, setting up a Docker container with all of our services. We had, a number of different services, maybe like 10 or 12, but 5 of them were like necessary to be able to run the system. So we actually had a Docker setup where we could run the whole distributed system on your laptop so that you could actually run components of it and do debug and work with the system. Because that was one of the key challenges for sure is, how do you design the system to kind of be like testable using Kafka, using this distributed approach? And then the last thing I wanted to circle back to is those exchange agreements. And this is sort of just like a systemic problem for Cove Market. So I meant that I mentioned that, conventional exchanges, they're willing to work with each other because they have financial regulation that says you must work with each other, right? You must offer best bid and offer to all of your customers. And of course, this was not the case in crypto. And what we found was a lot of the exchanges were sort of reluctant to kind of get into that with us. With Cove Markets, what the exchanges wanted was to treat us like an individual trader. So basically, they wanted to set up an arrangement where we traded our own money. so that the customers would come to us, and then we would trade with their own money on their exchange to be able to fulfill what the customer wanted. But if you can imagine, these exchange agreements enable leverage, right? So two exchanges, they may put up some sort of a bond with each other, $100,000 or something like that, versus the day's differences. But the actual outstanding orders is probably like much more than that. So if they actually want you to trade with your own money, it's going to be cost prohibitive. And so that was one of the challenges for Cove. But that's outside of like kind of the architectural discussion. I just kind of wanted to point it out there. But that's what I want to describe. Basically, this is the kind of simplified view of event sourcing that we built at Cove Markets.